let's go ahead and let's get started. First off, just, overall talking about what is a profit and loss statement. I think that, there's a term that's used, but it's sometimes good to step back and make sure we all understand exactly what it means when we talk about a profit and loss statement. It summarizes the revenues, the costs, and the expenses of the company. So it's one of the core financial statements that every business needs to be aware of and needs to use. And it focuses on these three things: revenues, costs, and expenses. A very specific aspect of a profit and loss is that it's reporting on a specific time period. That time period is typically a month. That's how most people look at it, but it could be a year, it could be a day, it could be a week, an hour, it doesn't matter. Whatever that period of time, what makes it a profit and loss statement, one of those components, is the idea that it's for a specific period of time. It's absolutely contrary to the balance sheet, which is the other core financial statement that most people will be looking at running, where a balance sheet is a snapshot in time. So it's saying that I want to see what my numbers were at this particular point in time. It's saying this is looking at it over a period of time and looking at activity. And it's going to provide information about the company's ability to generate a profit. So it's going to tell us whether or not we're making money, which is one of the most important reasons why this document is something that every business should be looking at, every opportunity they have to understand if they're making money. If not, why not? If not, how bad? And so they can make adjustments in their business in real time before it's too late to do anything about it. And unfortunately, one of the common challenges is that if profit and loss statements are not reviewed on a regular basis, that you don't have the opportunity to fix something. And as a result, the bleeding caused by that particular loss can continue for month after month after month, and that leads to businesses failing. Now, we talked a little bit about the concept of the balance sheet. The balance sheet represents a snapshot in time, as we mentioned, and it summarizes the financial position of the company, which includes the assets, which could include both money we have in the bank, accounts receivable, physical assets, fixed assets, as well as liabilities, what we owe, and the capital contributions to the company from investors, stockholders, whatever the case may be. Now, the balance sheet reflects basically the overall historical aspect of what's happened through the history of the company to where are we now. So if we were basically to liquidate the company right now, what would it be worth? And that's the concept of the balance sheet as compared to the profit and loss, which is telling us how we did in a specific specific period of time. Now, one of the most common questions that I get is, what is the difference between a profit and loss statement and an income statement? And the answer is very simple. There is no difference. These terms are generally used interchangeably, and you will find that I will probably, during the course of this webinar, use those terms interchangeably just naturally. It is not, these mean the same thing, at least in the common language of accounting, not necessarily that any one individual doesn't have a different interpretation, but one is level set that right from the beginning that they're the same concept, and I will probably switch back and forth between these all the time during the course of this discussion, as I do regularly in real life. So why should you care about a profit and loss statement? Yeah, that first off, it's the idea that it's timely information about your business. And timely is important. It's a reason that you have to get that information timely. If you only do your books once a year, you're not going to know what's going on in time to be able to react to it. So it's giving us information that's specifically intended for us to take some kind of action on and do something about. Right? So it helps us to understand the profitability of the company and allows us to make better decisions as a result of that. So we can look at it, determine whether or not we have areas that we have the opportunity to improve, reduce expenses, increase revenue, and at a very detailed level, and be able to take action. So it's going to inform your decisions and allow you to be able to make better decisions. It is also evidence of the success or the lack of success of the business. And that is why a profit and loss or an income statement is going to be a request that you get when you apply for a loan, or if you apply for credit with somebody, that they may request that information, because this is something we can look at to see, is this business on the right track to be able to continue to be successful. It allows us to evaluate the costs and understand them at a more detailed level. Allows us to be able to identify trends. And we'll talk about different types of profit and loss statements as we go through this, because there are variations of profit and loss statements that allow us to be able to see how things are trending over a period of time. And that way we can know if it's getting better or if it's getting worse. We can compare to budget. We can then take proactive action to improve profitability. My last box is last for a reason, but I really kind of reinforce that a review of a profit and loss statement should result in you taking some kind of action. What that action is depends on all the numbers that are on it, so there's no preconceived notion of what that is, but you should be taking some kind of action. So it should be inspiring you to ask questions, to dig into details, and make some changes. So let's break down the components of a profit and loss statement and talk about what each of them means and some of the kinds of variables that come into play. Now, as I go through all of this, realize that there's lots of different types of businesses, and there's a lot of variation in how businesses will record revenue, will classify expenses. So I'm trying to provide it at a general level, and I'll give some specific examples that apply to common business models, but there may be some variation from what you're doing, and certainly recommend that you speak to your accountant who you work with, who's familiar with your business, about making any specific changes, but wanted to provide a good breakdown of the kinds of things you should have. From a revenue standpoint, revenue is generally going to be your sales, though if you're a not-for-profit, it's going to be could be fundraising, but it's anything that's bringing cash into the business through some kind of sales or fundraising activities. Now, cost of goods sold is going to be our direct cost of products sold, and we'll talk a lot more about what that means in a moment. But you can see that the sales minus the cost of goods produces our gross profit, and we'll talk about each of these and break these down in a little bit more detail. First off, looking at revenue, revenue is our income from sales of goods or services. So if you're a consulting firm or a accounting firm or law firm, you're going to be doing services instead of sales of product. And it's your inflows of cash or promises to pay cash, depending on whether you're accrual or cash accounting, and we'll get more into that in depth in a bit. And broken up into categories that make some sense for you, for your business. So you can break down these sales on your income statement at any level of detail that makes sense to you. So it can just be one number. It can be broken down into lots of different categories. And all of that just depends on what's important to your business and what's interesting to you. And, it could be sales, rentals, different types of products that you have, different regions. There's a lot of examples of things. And I like this cartoon. I always like the one that the tooth fairy is the only source of revenue that I have. Now, when we talk about revenue and revenue recognition, an important aspect of that is understanding the concept of a cash accounting versus accrual accounting. We tend to think in terms of cash accounting naturally because cash accounting is all got to do with whether or not there's any money in our checking account. And so in a cash basis, you're recognizing revenue when you get the cash in, and you recognize the expense when you pay it. And so it's directly based. This is checkbook accounting. This is where you can almost run your business off your bank statement and be able to see exactly what came in and came out, and have that be what gets recorded in your books. So as you pay a bill, it's recorded as an expense. As you get money from your customer, you record it as income. On an accrual basis, you're recognizing the revenue when it's earned, and you recognize the expense when it's incurred, regardless of whether or not you have the money. And so if you were to charge a customer for something, that would be, you would invoice them, that would be accounts receivable, and you'd be recognizing the revenue now, even though they may not pay you for a week, a month, a year, or whatever the case may be. You're recognizing that revenue. Same thing on the expense side, that when they send you a bill, you recognize that expense, even though you may not pay it for a week, a month, a year, whatever the case may be. So that aspect of accounting is really important, and so why would you use one or the other? from a small business standpoint, a lot of small businesses use cash accounting just because it's somewhat easier. That I mentioned is kind of bank statement accounting, that you are not worrying so much about the swings from month to month, and you're focused on being able to just understand where you are from a cash position. Cash accounting is actually a little more accurate in the long run, but it tends to work best for small firms, less than 5 people, most of the time and materials types of work. But it is also the best way to compute your income taxes, because if you, at least in most cases for most types of companies, in that if you have a large amount of money that is due to you, if you have $1 million in accounts receivable right now, if you're on an accrual basis, you're going to have to recognize that revenue, and you're going to have to pay taxes on it, even though you don't actually have the money in the bank. So businesses that have very large cash swings sometimes benefit from cash accounting on their taxes. Now, on an accrual basis, some of the advantages of accrual is it gives you much better predictability of your cash flow, because you are looking at, here's my accounts receivable, here's my accounts payable, and I can predict out what my incoming cash is going to be in the months to come. It also gives you a better measure of actual performance, because if you do cash basis accounting and you look at it profit and loss on a cash basis, there's going to be huge swings from month to month if you are a company that is accounts receivable intensive. So if you take it, for example, that if you're in a service-oriented business where you're providing materials on a time and materials basis, you're going to incur expenses this month for money that you may not get for another 30 days, another 60 days, maybe even 90 days. And as a result, looking at the profit and loss of a particular month gets harder. So that information is just not as accurate. So there's challenges with that side of it. It does also give you, the accrual accounting does give you better planning. It allows you to be able to match the revenues directly to the expenses, so you can see how revenues and expenses flowed in comparison to each other in the same period of time, and allows you to more accurately measure all your assets and liabilities, because if you're cash basis accounting and not tracking accounts receivable or accounts payable, then your balance sheet may not reflect money that you owe just because you haven't gotten around to paying it yet. Now, the good news is that you can actually do both in most accounting systems. So in most accounting systems, you have the opportunity to run reports in both ways, which allows you the option to do what is very common, which is to manage your business with accrual accounting and file your taxes with cash accounting. So that is an option for many types of businesses. Again, depends on the specific types of businesses. Certain types of businesses have to file taxes on an accrual basis. But this is something that you want to make sure you understand what you're doing, why you're doing it that way, and understand what the options are, so you can be having those conversations to determine whether or not another method of accounting might be more appropriate for you. So when we talk about the next component down, cost of goods, there's a lot of factors that can come into cost of goods. Again, this depends a lot on the industry that you're a part of, but generally it's going to be the cost of whatever product you're providing or service you're providing. Now, in the more traditional space of manufacturing, of retail, wholesale, where you're buying products and selling them, or buying products and then making something from them and selling that product, your cost of goods is going to be whatever the cost is of those products. It could be the raw products if you're a manufacturer, the products that you're buying in order to sell. That is cost of goods. Now, other things that factor in the cost of goods, things like discounts, that generally cost of goods, where if you have a discount with a vendor that you're buying from, that would be recognized as an offset against cost of goods, and so you put it in as cost of goods. If you are a service company and you're charging for services, then if you have contractors providing those services, then that's a cost of good for you, because consulting is a great example of that. If I charge for consulting and then I have to subcontract it out to another contractor who charges me, then that is a cost of good, and the gross profit of that project is whatever my cost, whatever I'm charging minus my cost for that contractor. Freight in is typically, commissions is typically put. These are all costs that directly relate to the sale or the service that I'm providing. And it should be mentioned that cost of goods ultimately There's flexibility. There's not a lot of hard and fast rules of what has to be in cost of goods. There's some, but there's some of these are subjective. But ultimately it comes down to how we look at gross profit, which we'll get into in a second. So here's an example of a service company. So I've got revenue from consulting and expenses. In this case, there's no cost of goods because in this case, my salaries, my consultants are all employed, and as a result, there's no cost of goods at this company. What would be more typical is that you would have cost of goods involved. The next layer down is what's called operating expenses. And operating expenses is somewhat of an everything else, but this is going to be anything that you are paying related to the overhead of operating your business. If it directly relates to a product or service we're providing, it's going to go as a cost of goods. If it's not directly related, then it is an operating expense. And this is going to include things like rents, advertising, office supplies, salaries, utilities, maintenance. Attending this webinar is an example of that. That's training that belongs as part of your operating expenses. So these are just some examples, and you probably have a lot of different examples of these that apply in your business. The way that you categorize these is completely up to you based upon the way you want to look at that information. I generally recommend being more granular whenever possible so that you can do more analysis and you can decide what these operating accounts are. But all of these fall under this generic term of operating expense. So when you're categorizing operating expenses, there's two general categories of expenses that apply to most businesses. One of them is marketing expenses. This is anything related to selling our product or service. Now, it is not related to providing it. That would be part of the cost of goods. But anything related to selling it that is not applicable to a particular sale. So that's where commissions generally is a cost of good because it applies to a particular sale. But advertising or attending a conference is part of your marketing expenses because it doesn't relate to a specific opportunity. Administration, anything related like office supplies, rent, insurance, all these things that every business has, those are administrative expenses. They don't directly relate to selling your product or service. Again, you don't have to follow this exact categorization, and you probably have other breakdowns that would make sense for your business. But this is to give you an idea of the commonly used allocations between operating expenses and how they're defined. And you'll find that many accounting systems will provide you with this type of structure out of the box in their standard chart accounts. All this leads to what's one of the key aspects of understanding the profit and loss statement, which is talking about gross versus net profit. So gross profit is a formula that comes down that is simple as taking revenue and subtracting out cost of goods. What did we sell it for minus what did we pay for it? So again, going back to the common example of if I'm a retail store and I buy a product for $10 and I sell it for $20, then my gross profit on that sale is $10. And so gross profit on your balance sheet is going to be a combination of all of your sales for that particular period of time. The month, we'll call it a month because that's how a lot of people look at it. So all of our sales for the month minus everything we bought during the month, all of our cost of goods. That basic formula is essential to understanding whether or not we're making any money selling our product and the profitability that we're making off of those sales. And that's what you'll hear people use the term top line. That's your top line numbers. So the gross profit is telling us whether or not we're making money independent of our overhead. Are we actually making money off of the raw sales of these products or not? And if you're not making a gross profit, if you're losing money on a sale, that's a very significant concern, and that's something you need to be digging into. Now, the net profit is telling us that it takes the gross profit that we talked about before, and it takes out all those operating expenses. And the bottom line that we have there tells us how much money did we actually make during that time period, factoring in all of our overhead, all of our expenses. So you look at these two numbers differently because the way you act upon and address them is completely different between the two. But both of these numbers are absolutely essential. And understanding that difference between gross and net is a really important part of understanding how to talk about where your business is and how to take action against it. And those formulas are ultimately surprisingly simple when you look at it from this perspective. Gross profit is revenue minus cost of goods. Net profit is gross profit minus operating expense. So let's take a look at an example here that if we look at company ABC, getting really creative today. So company ABC profit and loss statement, we can see that the total sales was $19,000, and you can see the way that they break out their sales. So we're tracking design sales versus other sales, and we gave discounts on sales, so we're taking that, factoring that in as well, taking it out of our income. It reduces our income. And we have cost of goods for the products that we provided, and the difference between that total income and that cost of goods is our gross profit. So in this case, $19,526. This is a service-oriented business, so it looks like has very little cost of goods, and a lot of the money goes right into gross profit. That's great. But are we actually making money? Well, we have bank charges, we have marketing expenses, we have meals, entertainment, professional development, we have to pay QuickBooks, we have to pay for travel, and the net result of this is that our total expenses are $2,776. So good news, gross profit minus total expenses leads to a net profit of $16,750. In this case, it's over a 6-month period. So you can see how that difference comes into play. And in this case, this is a company with a very low overhead, and you can look at this and this is a good example of analyzing a profit and loss statement. That I can look at this and say that this company has very low overhead, has very low cost of goods. The fact that there's not even salaries, I would suggest this is probably an owner-operator run business where this person's like a designer and does all the work themselves, and as a result has very low overhead. That's an idea of just the kinds of things you can kind of read into the profit and loss statement. Next term, and I realize a lot of this beginning of this is a lot of terminology, but it's important to understand a lot of this terminology and level set what each of these terms mean. But the next terminology is gross versus net margin. So gross margin is the percentage of our income that is maintained as gross profit. So to take an example, if I were to sell something, if I have $100,000 in revenue, I have $70,000 in cost of goods, I made $30,000. Yes, I chose something where the math is easy. My gross margin is 30%. I'm keeping 30% of what I sell on a gross basis. The net margin is the income that's maintained after net profit. So I made $30,000. I have $20,000 in overhead. My net profit is $10,000. That is 10% of my sales, and as a result, my net margin is 10%. So it's just another way of looking at gross versus net, but looking at it on a percentage basis is important, because if I am somebody like perhaps an investor interested in investing in your business, I want to understand the percentages, because as the sales grow, I want to know what we're going to be able to keep on the bottom line. So if I were to just tell you I make $20,000 a month selling a product, that doesn't necessarily help you to understand my business. You know I'm making money, but you don't necessarily understand much about my cost structure. If I tell you that my gross margin is 50% and my net margin is 20%, that actually tells you a lot about how I'm running my business, because now you see that I'm selling a product where I'm getting a good margin, and I'm keeping my overhead costs reasonable, getting a 20% on the bottom line. And as a result, as an investor, if I were to put more money into that business, we could probably continue to raise that bottom line and perhaps increase the net margin, because we're able to get more efficiency out of the overhead. And banks and other things will look at that in the same way. Another term that you hear a lot is EBIT and EBITDA, and these again from a terminology standpoint, just kind of want to break down the barriers of understanding what all these things mean. But when we talk about earnings before interest and taxes, what that is used for is to understand the cash flow generated by the operations. So this tells us how much money do we make before we paid interest and before we paid taxes. So when we looked at the net profit before, there's actually one more layer down you'll see on some profit and loss statements, which will be the interest that we paid or earned, because you can earn interest as well. and the taxes that you paid. And the reason that we want to track that is that the difference between the net profit and what we pay in interest and taxes impacts the cash flow more. So if you pay a lot of money in interest because you have a lot of loans, even if you make a high net profit, you may not actually have much cash flow as a result of that because you have to pay a lot of that in interest to the bank. The higher your interest is, the more that your net profit is going to be reduced as a result, and that's an important number to look at. The second thing so when we talk about EBITDA, that is the same thing, but it adds in two more aspects. It adds in depreciation, and it adds in amortization. So depreciation is going to be, and amortization is going to refer to the reduction in value of our assets over time. So, for example, if you bought a company vehicle, then over time you're going to depreciate that vehicle, and each time you depreciate it, it's going to reduce your income. But because that depreciation is not actually related to the costs that we're paying during the month, you put it in a separate section. We have to consider it and factor it in. But we're tracking EBITDA separately because when you're an investor looking at the profitability of a business, you want to factor in the value of these assets. You want to be thinking about the usage of those assets. So when you talk about company valuations, is particularly where this becomes useful, that's an important number to look at to help to value the companies and to factor in the capital investments that they've put into the company over time, with both depreciation and amortization, depending on the type of asset, being the way that the value is reduced over time. So these numbers will apply in particular circumstances. EBITDA is going to be particularly important if you're either a public company or if you are selling your company. That's something that's going to be looked at much more closely. But when operating your business, the key thing to understand is the idea of that the cash flow aspect of it, which is based on your interest, is different than the depreciation, because depreciation is going to reduce your profitability, but you've already spent the cash. And when looking at that EBIT and EBITDA are going to be higher than your net. So you can see the formula here. So I can see that depreciation and amortization added on to our earnings before interest and taxes is going to result in a higher EBITDA because we're adding back in the depreciation and amortization. So talk a little bit about profits versus cash, because I think this is a confusing point for a lot of people, that particularly smaller businesses look at cash and say, if I have cash, I must be doing well. If I don't have cash, I must not be doing well. And the difference between profits and cash is important in the sense that a cash sale to a customer, for example, results in cash coming in the door, and it results in revenue. So in that case, if you're on a cash basis, that's a sale, and you've got revenue, you're bringing in cash. But if you do a credit sale to a customer, you're getting revenue on an accrual basis, but you're not getting any cash. If you raise capital, so if I were to get an investor, that's an influx of cash, but it's not revenue. And then you get a bank loan, that's an influx of cash, but not revenue. Customer pays an invoice, it's an influx of cash, but it's not revenue because we already recognize that revenue. So understanding of those differences and the trigger points about what impacts profit and cash is important. Okay, so now that we've spent a lot of time talking about terminology, let's spend some time talking a little bit more about the profit and loss statement itself, and how we go about creating them and reading them. But we'll go into a lot of detail about what's in profit and loss statements, but having all of that terminology worked out helps us to be able to have that conversation. So first off, looking at how do you create a P&L. So profit and loss statements can be created manually. You can create them in spreadsheets, but honestly, the way everybody should be creating them now is in accounting software. QuickBooks, whatever it is that you happen to use. There's a lot of great solutions out there. And actually, I would strongly recommend not doing it any other way and not providing it to anybody any other way. If I see a spreadsheet-based profit and loss statement, it's instantly going to raise an alarm to me about how do I know that this content hasn't been manipulated in some way, while something coming out of a financial system is going to have instantly more credibility. Plus, there's the reality that all these systems do a great job of producing these profit and loss statements, have many different formats available for them, and there's a lot of great solutions. And even at this point, there's even a lot of free solutions for accounting for businesses. So there's just so many choices that you should be in a position where both you can leverage an accounting software solution as part of what you're doing, and that you can trust that accounting solution to produce profit and loss statements for you. When you look at some of the options around accounting software, depending on the size of your business, QuickBooks is definitely the biggest in this space, but there's a lot of QuickBooks competitors that have come up in the last few years on a smaller business scale. And some of these, like Xero there is free. Wave Accounting is free. There's a lot of different solutions that have free versions that meet the needs of a lot of businesses. And then when you get into medium and larger businesses, there's a lot of solutions that not necessarily far from free, but there's a lot of choices depending on the type of business that you have. There's a lot of different ways you can go about tracking. I'm not going to speak too much about specific solutions and how they work for financial statements, because pretty much any of these solutions are going to print out financial statements in all the different ways we're going to talk about. And if not, then there's a variety of other ways you can go about it. But you can count on any accounting solution to be able to produce what we're discussing, whether it be out of the box or with some minor tweaking of the templates that they provide. So we're going to go through a lot of examples, as I mentioned, and talk about different ways that you can go about looking at your profit and loss. And first, from a budgeting standpoint, I think that budgeting is a key aspect of running a business, and budgeting is something that you have the option of putting on your P&L to understand, give context to the numbers that you're looking at to see how they compare to your budget. So if you looked at this particular month, and if you took the budgeted column off of there, and you can see that we sold $94,600, your interpretation of that might be that that's good, might be that that's bad, but without context about what we expected to do, it's hard to know. Now when we can look at it, and we can see with budgeted there, that we can see we budgeted $100,000, so we came in under budget. So this wasn't dramatically under budget, but it was 5.5% under budget. So our sales were not what we expected them to be, and that's a concern. And so the context provided is actually even more valuable when you look at the bottom line here, that I may not necessarily realize that $16,000 is more than I should pay for water and electricity, but when I see compared to my budget, I can see how that compares, and I can see there's a difference. So when we look all the way down to the bottom line, the net profit, that I can see that we budgeted to make $39,000 this month, but we only made $30,820. Part of that is because our sales were below budget, and part of that was because we had a few expenses that were higher than budget, and you can see some of them here. And this allows us to say, now you can see how this makes this data more actionable. This raises some clear, obvious questions. Why were my sales under budget? Why was our electricity bill so much higher this month than it was compared to what we expected? Why did we spend more money on fuel? Why did we spend more money on taxes? All these why questions are a really important aspect of P&L analysis, and adding in the budget to that screen gives us so much more flexibility to be able to ask the right questions through the course of that analysis. So we'll take some more examples of that as we go. Percentages are another great way to make the P&L more valuable. And so here we're adding in our margins. So here when we look at the total revenue is $100,000, we can see our cost of goods and our gross profit. And we've added in the margins that we talked about before, as well as percentages all the way down the line. So we can see here that salaries was 11% of our gross sales. We can see that rent was 10% of our revenue. So each of those, when you go down the list, gives you a little bit more context as to how significant that expense is, and allow us to be able to determine whether or not it's something we want to dig into more. And again, all of this is about making this information actionable to help you to be able to drive better decisions in your business. So each of these all along the way that percentage allows us to have context. We can go back and we can see, well, our total operating expenses are 28%. Salaries and rent is where a lot of money is. Maybe that's where we need to take some kind of action to improve the profitability of the company. Now, when you add in a couple more variations of these, so the next one is the budget variation report. So in a budget variation, we're looking at the budget just as we were before, current period and budget, but we're making this a little easier by doing the math for you and providing both the difference in dollars and the variance as a percentage. This, again, helps to be able to scan a profit and loss quickly and decide where we need to take some kind of action. So in this case, if I look at it, our gross income was 20% above budget this year, this month. So that's great. So we made more money than we expected to. And we can see specifically, again, without even looking at the numbers, you can just see this by looking at the percentages and then zeroing in on the numbers from that. The labor sales, we did 41% over budget in labor sales. That's great. And you can see some of these different numbers and how they impacted that. When we go down to the bottom line, we can see that our operating income was 40% above budget, and we can see that that we actually were that the some of the expense categories that were below budget include the travel, the advertising expense. So our salaries were slightly above, but given that we were 20% increase in sales, that probably is the explanation for that. But we can see here that we were able to actually cut our advertising, cut our travel, and cut our office expenses all at the same time. So that resulted in our income being quite a bit higher than we expected it to be. So that's the kind of way you can look at a budget variance report. And again, your accounting systems probably print these right out of the box. If you just check the right boxes and add the right columns, depending on your solution, then you would be able to see this information and make that profit and loss more actionable. Another type of profit and loss is a comparative income statement. So in a comparative, we're directly looking at how did we do this period of time, this year in this particular example, versus a prior period of time, last year in this example. So in this case, we're looking at comparing this year, 2011 versus 2010. So you can see that our net income in 2011 is $990. Last year, we made more money. So why was there a difference? In this case, there was a 17% decrease in our net income. So we can look at all these different categories and see, well, our sales this year were actually better than last year. We actually did $4,000 more in sales, 26% more. So what went wrong if we sold more? And then you break it down and you can see that our cost of goods went up by 33%. It's a good example that when you would expect cost of goods go up as sales go up, but in this case, cost of goods went up more than sales went up. We also had a big increase in sales returns and allowances. We also had selling administration expenses go up. So we can break down, we can look at every category, and we can figure out where that difference is and better understand why is it that we made less money even though we sold more. And another category of the income statement is to look at the profit and loss over a period of time. So in this case, we've got one report that's showing us every month over the course of this fiscal year, and we were able to see where how we did month to month, and this allows us to be able to identify trends. And we talked a little bit about looking at trends before. So here, if I look at the gross profit per month, I can see that we're actually trending in the right direction. As a matter of fact, here in December, we made $31,000 in gross profit. That's a great number compared to where we were in March, where we've increased it quite a bit. And then we can look at all the expenses and be able to see the same thing. And our expenses is trending up as well. But the bottom line, our net income is also trending in the right direction. So we're able to draw those comparisons. I can see here, for example, something like the payroll expenses, see how that trends, insurance expenses, see how it moves from month to month. And this will help you to have a better understanding about, is something a one-time spike or is it an ongoing trend that we're continuing to have these expenses be higher than what we had expected. So another example of a very common method you can look at things. And there's a lot of options and variations here about what different ways you can go about looking at the profit and loss statements, but each of them adds value and gives you context in a different way. Next thing I want to just mention is the concept of classes. And this is a QuickBooks specific term, but every solution will have a variation of this concept where you're able to classify an expense into categories that allow you to break it out easily on the profit and loss statement. Project accounting in many systems has very similar concepts, so you can track the success of projects and the profitability of individual projects. But this allows us to have a better understanding of how a particular segment of the business is doing in comparison. So in this case, we're drilling down into more detail behind this particular company, and we can see that they have a commercial and a residential division, and we can look at how each of them contributes to the sales. So residential is 69% of the sales. We can see how they contribute to the profit. We can see here the profitability of each of those divisions, and we can see then the total expenses. And in this particular example, they don't break the expenses out between those two divisions, probably because the expenses are generic to the business. There's a single office and a single staff responsible. They don't break down between commercial and residential. So we're only tracking sales and costs and, as a result, gross profit at the divisional level. We're not tracking expenses at the divisional level. That's a very common model and a model that works and allows you to be able to see how you're trending from a profitability standpoint. So in this case, we can see the gross profit is not only higher in the residential division, but it's actually higher on a percentage basis as well. In comparison, another way that you can look at it is to look at is to break out the expenses as well. So another variation of this, if you would go back here, is that you can choose to break it out. If you know that certain expenses apply to one side of the business or the other, you can charge them to that particular division. As a result, get a net profit for that division. That can be helpful as well. So it depends, again, on how you break out your expenses, how you classify your expenses, and how you work with it. Now, here's an example for a not-for-profit. So if you're a not-for-profit, some of all the concepts here apply, but some of the ways that you specifically go about it might be a little bit different. And so you're going to typically have grants or money coming in that is your income from events, from fundraisers, and then you're going to have expenses that have come out. And so you'll have some different reporting. This is an example of a report that allows us to be able to see our sources of funds from different grants, for example. But you also will have a very similar income statement. Apologize, I don't have an example for that shows our net income with all the expenses for a not-for-profit. Again, the concepts are very similar and work the same. So the next section I wanted to go through is to talk a little bit about how to use all this information within your business and how to leverage in a practical way a profit and loss statement. First off, examples, just good examples about the idea of the importance of looking at these documents to be able to understand how your business is trending. But the big picture of the P&L is you want to understand whether you're making money or not, and then to understand how we can make more money. Because even if you're profitable, that doesn't mean you can't be more profitable, and you can't set yourself up for more success in the future. And if you're not profitable, the sooner you realize that and find the opportunities to tweak your expenses to be able to increase profit, the better. And one of the constant challenges people have is deciding which expenses to tweak. But the sooner you make that decision and make those tweaks, the sooner it's going to have a positive impact on your bottom line. And overall, a profit and loss statement should be making you ask questions. And the question words that you hear: who, when, where, how, why, what. These are the kinds of things you want to be asking. Why is this particular number higher than I expected it to be? What is behind this particular expense? What is the detail? And all of these kinds of questions are going to lead you to better understand the finances of the business and what actions you can take. The profit and loss is intended to make you ask questions. So if you are reading a profit and loss and not asking yourself questions, then you should ask yourself the question, why am I not asking questions? Because that's exactly the purpose of this document. If it's just a glance at it, make sure it's there, it's not adding value. You want to be having it lead you to ask questions, understand how to focus your time in order to be able to make your business more successful. So here's some examples of questions that you could ask. There's a lot of variations, but here's just some ideas. You can say, how does my revenue compare to last month, to last year? So when you're looking at a monthly financial statement, what did we do in revenue last month? How does that compare to what we did this month? How much money am I making after expenses? What is my net compared to my gross? I'm looking at those margins that we talked about before. Spending versus your budget. So what did we actually spend versus what did we budget to spend? Is my cost of sales increasing in proportion to my sales, or is it increasing faster? And that overhead could be a very similar concept. Is my overhead increasing faster than my sales? All these are just examples, but the kinds of things you should be asking as you're looking at those documents. So when we talk about managing and using our profit and loss statements, that a lot of the considerations you think about, how do we keep it current and make sure that it's up to date? Doing your bookkeeping as you go is an important aspect of that. Making sure that you get a P&L out timely is really important as well. One of the mistakes that larger companies, smaller companies tend to make the mistake of not keeping their accounting up to date in general, and as a result, they're not able to produce these profit and losses. The larger companies make the mistake of taking too long to complete the process, and by the time they get these documents out to people, it's too late for them to take any kind of action to improve the following month. So keeping things current is an important aspect of managing your profit and loss. Making sure that you get it to the right people on a timely basis is an important aspect of that. And then looking for flags, and we'll talk about some examples of the flags of the kinds of things you should be looking for when analyzing your profit and loss statement. You also want to be managing profit and losses proactively, and that means that creating detailed accounts. So, what accounts exactly make sense for your business is going to depend entirely on your business. But if you have a lot of money flowing through a particular account, it might be worth looking at it at a detailed level. And if you ask too many whys about a particular account, that may be a suggestion that there isn't enough detail broken out on your P&L around it. At the same time, if you have accounts that typically have zeros in them, then perhaps those are accounts that should be consolidated with others to make reading the P&L easier in the future, or typically have low numbers in them. But you have to decide what level of detailed accounts you want to create, and that's something you should be constantly evaluating and adjusting for based on the realities of your business. Most accounting solutions of the smaller businesses are going to come with a pre-canned general ledger, and a common mistake smaller businesses use is just to stick with it and to not realize that there's accounts there that don't apply, while there's other accounts that do apply, but aren't broken out in enough detail. The setting goals and projections is an important aspect of that, and part of that is building a budget and making sure that you have a budget tied to all your general ledger accounts, which allows you to be able to proactively determine whether or not you're sticking with what you projected. You can say, I expect to make this much money for the month, and by budgeting and by letting people know what that budget is, then that allows you both to hold people accountable as well as to be able to make informed decisions about what you're buying and what you're spending. So creating a budget is an important aspect of that. And then that allows you then to be able to plug in those numbers and have it appear as a budget versus actual on your profit and losses. You want to be acting upon your P&L data. And that means taking action to cut costs. Sometimes that cutting costs is going to be reducing expenses. That could be people. That could be cutting spending. But that's the kind of thing you should be looking at. And if your profitability is not where you need it to be, or if you find waste in spending, that you want to cut costs. You want to look at that to reduce cost of goods, because if you determine that you're not buying your products cheap enough, and your gross margin is not going in the right direction, that might be an indication that you need to reduce your cost of goods by perhaps finding a cheaper source, or perhaps that means offering less discounts, or perhaps it means that you need to reduce your freight costs to get your products. There's a variety of different ways, but that's part of what you want to be looking at, as well as why your revenue itself is not on target, because if your revenue is trending in the wrong direction, then that's something that the P&L is intended to catch for you and help you to be able to address. Part of developing goals is the concept of creating targets and metrics. And so when we talk about goals, we always talk about it in terms of SMART goals. That you can't simply have a goal to increase sales. That's not a SMART goal. A SMART goal is specific, measurable, attainable, relevant, and timely. If we look at each of those, specific means that there's a very specific objective. And it's something we can measure. It's something that we think we have a reasonable opportunity to attain. It's relevant to our business. And it's timely, meaning it has a particular time period attached to it. So I want to increase my sales is not a goal. A SMART goal, would be to say, I want to increase my sales by 10% by the end of the quarter. And that's something that you could then measure, see whether or not you achieved it over that very specific period of time. And then you break that down and hold people accountable as a result of that. So I can establish SMART goals with each of the people within my business, with divisions, with employees responsible for particular areas, and they can be responsible to achieve those goals. So I can ask a particular division to increase their sales by a specific amount and work with them to determine what that amount should be, or to cut their expenses, or whatever the case may be. This applies not just to your profit and loss, but overall to your business as a whole. The idea of establishing goals that are SMART and as a result can be measured to determine whether or not you were successful in them. All right, so some considerations I want to put out there in regards to looking at your profit and loss. Just a lot of factors here that come into play depending on your type of business that may impact your ability to review the profit and loss and how you go about looking at it. First is seasonality. Depending on the type of business you're in, you may have variations from month to month or from particular aspect of your business, particular periods of time, may vary significantly depending on the season. And you want a real extreme example of this. It might be if you're in some kind of a holiday-related business. So if you sell Christmas trees, then there's a really good chance that you do 90% of your business from Thanksgiving to Christmas. And if so, you're going to have a lot of months where you're spending money where you have very little sales during the course of the year, and then you're going to have this big spike. Businesses that have seasonality have a lot of interesting challenges attached to them. In relation to profit and loss, I think it makes budgeting and comparative trending really, really important. So you want to budget to make sure you control your expenses during the months that are not seasonal, that you know when you're going to be spending money so you can control your cash flow, and that you look at your sales on a more and your profitability over a more extensive period of time to factor in the realities of so much of your business is in a short period of time. Yeah, a less extreme version of this is going to be anybody who's in a toy business, for example, where it's still seasonal and still the same season, but you might do 75% of your sales in the last 6 weeks of the year. So there's a lot of examples like that may apply to your particular type of business. Yeah, and there's other examples that can come into play in terms of that, just thinking, immediately now, if you're in the face mask business, you probably have some interesting spikes in your sales. And so there's also an aspect of the fact that events can drive unintended seasonality. Accruing expenses, that consideration is that if you have one-time expenses that are large, that provide benefit over an extensive period of time, like for the year, you have the opportunity to accrue those expenses. And what happens there is that you're paying for it and putting it on the balance sheet and then spreading that cost out through an automatic allocation over the course of the year. Common example of this is insurances, where you might have a one-time large payment every year, and then you don't want that to create an unintended dip in your balance sheet, in your profit and loss, so you spread it out over a longer period of time. And you can see the specifics of the entry here into the general ledger, what that would look like. This would only apply if you're doing accrual accounting, but most businesses have some examples where accruing of their expense would be appropriate. Some more than others, But just the consideration that if you do see that you have one-time expenses creating large spikes or dips in your P&L, then that probably is a good candidate for an automatic accrual. And the accounting solutions available make this really easy, so this doesn't have to be a lot of effort, and it will help you to be able to create a more appropriate profit and loss that measures the true success of the business over that period of time. And, next thing to think about in consideration is the profitability of items, that I think it's important to look at the profitability of specific products if you're selling any types of products, physical products, digital products. So you want to be looking at your manufacturing cost. How is it that you're doing on that particular product, so you can determine whether or not there's products that you need to cut. And that gets into digging into that gross profit. That in the end, if you're not making money selling something, you're not going to make money by selling more of it. You're going to lose more money, right? So the profitability of the items is really important to be looking at. And if you sell a large number of items, the more analysis you can do to understand the profitability of each one, so you can focus your time on higher margin products and cut low margin products, the more likely you are to be successful. So you want to make sure you're looking at profitability outside of the profit and loss on an item basis through other reporting available through accounting systems. Inventory is a common area that I think a lot of people miss, and it is not uncommon that a large amount of the inventory on the balance sheet of a business isn't actually worth what the number is. And the result of this is that you have that your business is not worth what you think it is, and you've got large amounts of losses that have not been taken. And at some point, there's going to be a reckoning, and you're going to have to take a big hit on your profit and loss. And some examples of that is damaged inventory in our warehouse, inventory levels that are too high. As a result, you have inventory that's stuck that you can't sell. So defective inventory, if you overproduce. You have slow-moving inventory, spoilage, so if you have any inventory that has risk of spoiling, and dead inventory that you just can't sell. When you look at some of these examples like damaged inventory, every time you find out that there's damaged inventory in your warehouse, you should be taking a hit on your P&L for the value of that inventory and disposing of it. Same thing with spoilage, which has a very similar impact. When you have slow-moving inventory, you have the reality that it can be very hard to liquidate that inventory if you need to. And then dead inventory, for example, if you have a warehouse full of iPhone 1 cases, there's a good chance you're going to have a hard time selling those. And that's an example of inventory that may be dead. If you are stuck with dead inventory, that inventory has no value, and you need to write it down in order to have an accurate profit and loss statement. So if you're an inventory-oriented business, I would just suggest that you take a really good look at your inventory write-off practices to make sure that you are accurately reflecting your profit and loss, and that you're not ultimately that there aren't losses hidden in your balance sheet that at some point are going to come out. And the more timely you are about recognizing these, again, the more accurate your ability is to understand the profitability of your business. So some red flags and things to look for as you're going through and looking at your profit and loss statement. And this is just a variety of things just to kind of catch your attention, items that you should be paying attention to. This will be the last big section, then we'll get some time to open up for some questions and discussion. Think that increasing sales is always a good thing, so we want that. But one thing that should just catch your attention as a red flag is if sales are increasing while profits are declining on a percentage basis. So this could be an indication that your overhead is growing faster than you can afford for it to grow. And when you have growing sales, sometimes it's easy to get excited and to start increasing your spend, thinking that growth is going to continue. But if that growth slows down, that increased overhead is going to catch up. So one of the things to pay attention to is making sure that your overhead costs are not increasing faster than your sales on a percentage basis, and that you have a clear picture about how those two compare to each other. So again, it's something to watch for, and that's a great example of where net margin comes in as a really valuable number. So we can see the revenue and the increase in revenue, and let's look at the net margin. How is the net margin trending? If revenue is increasing, net margin is decreasing. It's a red flag. Again, maybe that's okay. Maybe that's what we want. Maybe that's something we recognize we need to do as a business. But it's something that should raise a flag. Have you ask a few questions to make sure that you're comfortable that you're making all the right decisions and that there's not an opportunity to slow down that spend a little bit and increase that profitability. Another thing to watch for is variances from budget. I think that one of the challenges with budgeting, honestly, is that a lot of people just don't pay attention to it, or they budget numbers that are overly generous or overly ambitious. So realistic budgeting helps you to be able to manage a business effectively. So you should be looking at the variances from budget. And sometimes it's reasonable to say, hey, maybe our budget was kind of unreasonable to begin with and adjust it. That's not wrong to do. That can be appropriate. But you want to make sure you understand why you're varying from those budgets. And if you have variances from budget on a regular basis, that's an indication that something isn't going the way you want it to and there's a trend in the business that you need to correct, or it's an indication that your budgets just aren't realistic and you need to make adjustments. So I would just suggest that first off, if you do not have budgets to appear on the profit and loss statement, I would suggest adding them. And don't worry about getting the budgets perfectly, because it's better to put something out there, have some variances, and tweak based upon the reality than to hold off on doing this at all. So just a consideration, something to be thinking about as well, and something that can indicate that could be a red flag. Stagnation is another red flag, and this is a red flag for a lot of investors and banks. That just the concept that if you're not growing, you're dying. And so if you're seeing stagnant sales, revenues aren't moving much, that could be an indication that something's wrong. You want to see growth in businesses, particularly, again, if you're looking at an investment. So there could be reasons that growth's not happening, but it's important not to get complacent with the numbers and just feeling that if they're consistent, that's a good thing. You want to be seeing growth. If not, you want to be challenging those numbers and trying to get to growth. I mentioned creeping overhead a little bit before, but watching those overhead expenses, and there's a lot of examples of things that tend to increase over time. Just the realities of running a business, that there's a lot of unexpected expenses in running a business. And as you grow your business, insurance is going to get more expensive, utilities are going to get more expensive, all these things are going to increase. And so watching the rate at which each of these expenses increases compared to your total salaries, compared to your total revenue, is a very important part of keeping your profitability in check. So, in summarize, looking at the profit and loss statement, that I like this from Napkin Finance. I think is if you haven't seen this, they do these back of a napkin explanations of a lot of different topics, and I love this particular one. So, an income statement reflects our company, shows the profit and loss over a period of time. Profit and loss, ultimately, the key number is that net income, which is our revenue minus expenses. We mentioned that there's the gross profit, which reflects the revenue minus the cost of goods, and the net profit is going to be that minus the expenses. So it's a little bit more of a detailed version of what's shown here. Why is that profit and loss important? It reflects the financial health of your company, helps you to understand where you have weaknesses, and helps you to make better decisions so that you can make changes in your business and leverage the information in order to be able to take timely action. The word timely doesn't appear here anywhere, but I'd reinforce that timely is absolutely critical. The bottom line comes from your net income, and that's the last line of your profit and loss as reason. And this document, if used properly, should be a very key aspect of how you run your business, and something you want to be paying attention to and looking at every opportunity. At least monthly. In some businesses, you may want to be looking at it weekly, even daily. Retail does a lot of daily profit and loss analysis, as an example. Depending on your business, you're going to look at it in different ways. We talked about budgets and variances and projects. All these are different examples of things that may apply to your business and how you would use the P&L. But in every business, in every case, P&L should be a key part of what you're doing to be able to understand how your business is doing and how you can help it to do better in the future. So with that, I think I'm right at time to start up a question. So I want to go ahead and ask the moderator if we can open up the floor for some questions.